Well, thank you very much, ladies and gentlemen. We continue the dialogue and the conversations here at the Reforms Reloaded platform, and it is my pleasure and privilege to welcome here the Chief Economic Advisor, Mr. Anantha Nageswaran. Thank you very much, sir, for joining us here this afternoon. Let's start with GST as well as the impact that the government hopes this GST cut will provide as an impetus to the economy. What's your own expectation? Do you believe that you now feel confident enough to review upwards your growth projections for the economy, or do you believe that the band that you had articulated in the economic survey still holds?
No, I think the GST 2.0 is a very significant landmark reform. I am very confident that under the circumstances it will provide a very significant boost to domestic demand, because if you look at the total amount of taxes that is estimated to be foregone is exactly the amount of savings that the households are making, coming on top of the direct tax relief or concessions made in the budget. And then if you sort of take in the multiplier effect, it will definitely add quite a bit to the GDP numbers. While I should actually be looking at revising my numbers upward, given my cautious nature, I will simply say that I am more comfortable now that the final number, which we have given a range, 6.3 to 6.8% in real terms, I am more comfortable now in saying that we will be tending towards the upper end of this range rather than the lower end of this range, considering what's happening on the external front. So that is the extent to which I am prepared to sound more relaxed and confident at this point. But once second quarter number comes, then we will revisit the estimates.
No, we'll take that, the higher end of that band that you had laid out in the economic survey. But if we could just understand the stimulus provided by both the income tax cuts as well as the GST benefits. The Prime Minister gave a number of 2.5 lakh crore rupees when he addressed the nation yesterday. What's the estimate that you're working with? Because I'm sure that will go into the budget math as well.
No, I think his numbers are quite appropriate, taking into account both the direct and the indirect taxes, because especially focusing on the indirect tax cut, GST 2.0, it's a combination of three components. One is the reductions in rates from, many categories going from 18 to 5 and the 12 becoming 5, etc. That is one major chunk. The second chunk is the withdrawal of the compensation cess. These two are very positive to the households. The small minus is the one where few categories where the rate goes from 28 to 40. So the final tax savings is the first two components minus the third component, and that number will be upwards of 1 lakh crore. And then if you really assume a marginal propensity to consume, as they call it, MPC in the economist jargon, which basically means depending on how much households consume, then it leads to further income growth, and so 2-3 rounds of multiplier effect, then the total impact on the economy will be even more than 2.5 lakh crores. So I think what the Honorable Prime Minister said was purely the static estimate of the tax saved for the households. But the impact on the economy can be bigger. But of course we know that there are other uncertainties and other factors which may dilute some of this translation of the savings into aggregate demand or GDP growth, as we call it, but the total impact is of this order of magnitude between the direct tax relief and the indirect tax relief put together.
I'll come to the uncertainties that you alluded to in just a second, but I just want to continue with the GST conversation and talk about the impact on states and state finances, because many states came out and said that they were concerned about the revenue impact that they would have to face. As you look at how things are panning out, and we've just seen the CAG numbers also come in as far as state revenues are concerned, what's your own indication, considering the fact that there is no longer any compensation cess?
So, look, in fact, former RBI Governor C. Rangarajan and Mr. Shanmugam, former Finance Secretary of Tamil Nadu government, wrote an article before the GST Council met about 3 weeks ago as to how well states have done with GST. And they particularly pointed out that the producing states, which were concerned about GST impacting them adversely, actually have ended up doing much better. So that's one. The second point I would like to make is GST rate, the revenue neutral rate, which was around 15% when GST came into being, actually has been coming down even before this happened. So by last year it was down to 11% something.
Yes.
So there's a 4%. Every time the revenue neutral rate or the effective GST rate came down, but the annual average collection actually kept going higher
up
and higher. So you already have a track record where the reduction in the GST rate, effective GST rate, did not result in decline in GST revenues. But revenues were having a step up function every year. And this happened even in 2019, before the election, sometime in February, March or April, I don't know the exact month, when the GST significant reliefs were announced, there was a concern that it would lead to a decline in revenue. But immediately after the election, the monthly numbers picked up within no time. So these two examples, I think, give us encouragement that the volume growth will make up for the static calculation that, as the rate drops, the revenue collections will drop because the volumes will go up. And the last point I want to make is, last year I wrote a paper co-authored with the Joint Secretary in the GST Council. We both wrote saying that whenever UPI transactions they pick up, they have a very high correlation with GST revenues. And UPI transactions are growing,
record highs.
Going at 20 to 30% per annum year on year, every month. So the rise in UPI transaction is actually a very good harbinger of GST revenues continuing to rise, and with the rate cut, the volume effect will dominate. So we shouldn't be overly concerned because the track record is there. Rate reductions have led to more formalization rather than less formalization, and that means more revenues.
That means more revenues,
more
and
transactions,
hence, more transactions, and hence you believe states have little reason to be concerned at this point in time. Which brings me to the question about the government's own fiscal math. We are, of course, getting into the budget making exercise. Do you believe that this will have any impact as far as the government's own fiscal math is concerned?
I think we are confident that the final number will be 4.4% of GDP, which is the gross fiscal deficit. We have had good non-tax revenue growth, and overall revenue growth is on track in comparison to last year's numbers. And we feel that the festival season will last all the way until the end of the year because of successive, the Diwali festival spilling over towards Christmas and New Year, etc. So we are confident that the fiscal math will hold up very well for the current financial year.
The Q2 numbers should be out shortly at the end of this month.
Q2 of the GST numbers, you mean?
No, GDP.
GDP for the second quarter will come only in November.
November. That's right.
It comes only end of November.
Correct. But what's the expectation there on the back of the data available so far?
No. I think I don't want to, sort of. What shall I say, jinx the GDP number. But from whatever we have seen in the first 2 months of July and August, the second quarter numbers look very encouraging. Very encouraging. We may be getting closer to the 7 handle, even for the month of, even for the second quarter, notwithstanding the tariff that came into effect from August 3rd week onwards. The fiscal second quarter growth numbers are looking quite promising based on the high frequency indicators we track. But of course, that is still only about 1.5 to 2 months of data. So we have to wait and see how much, how did September fare, etc. But we're sort of quietly hopeful that the second quarter has maintained the momentum that we saw in the first quarter. And
so closer to the 7% mark is what you're hoping for, but on the back of what the information you have.
I'm hoping for, rather than saying I'm predicting it. I'm not predicting it.
Fair point.
I'm simply saying, based on the trends I have seen, it's the number that I hope for. Yeah.
Okay, yeah. We'll take that. So you talked about the tariff impact, and what is the expectation if this were to continue? I mean, the hope is that we will be able to arrive at a middle path, and there will be a conclusion to the trade negotiations that are underway. We don't know whether that will result in 25% of the additional tariffs being done away with. But if 50% continues for the foreseeable future, what will the impact be on the economy?
I think it will have an impact. I think for this year, maybe obviously it will be slightly muted because half the year went away before the tariffs kicked in. And we also achieved 50% of our annual merchandise export to the US by August. Yes. So this year the impact will be, I mean, but then it will be diluted or compensated for by the GST cut, etc. So it will be very difficult to give you a net effect. Let's assume that, so we have to make some simplifying assumptions. If the GST rate reductions were not there, based on what we knew at that time, by the end of August or something, we could have said this year's impact will be about 0.4 to 0.5% of GDP reduction. And next year, it might be, I'm saying reduction from what? You might ask. Reduction from the trend growth rate of 6.5%.
Right.
That is what we would have said. And next year, it would have been closer to 1%.
Right.
But again, now that the GST rate reductions have happened, it might actually be a lower impact than what I just now mentioned.
Since we're talking about the impact of the tariffs, and that is on goods so far, but what we have seen over the weekend is the first indication of the Trump administration now trying to go after services. H-1B is the first move that's come in. Of course, there have been clarifications that the administration has put out, which have sort of provided some relief to what was expected as the worst case scenario. What is your impression, assessment of the impact of this, especially when we talk about remittances, etc.?
No, I think it's still very early days because, as you said, clarifications have been issued and 2/3 of the annual visa issuances is pertaining to renewals. So, and that is not affected by this new announcement. And I think the fee also, if I'm not mistaken, I think NASCOM has clarified.
It's a one-time.
No, not only that. I think it kicks in from 2026.
Yes, from the next lottery. That's correct.
From the next, which is 2026.
26, correct.
So I think in that sense, the impact will not be immediate. And I think there will be, by the time the next lottery comes around, I'm sure there is plenty of room for the American companies and the Indian companies to figure out ways to deal with this, etc. So I think it is still, having seen the announcement only in the last couple of days or so, it is difficult to give you a quantified impact of what it would mean for remittances or for services sector, export growth, etc. But again, considering the clarifications issued and that it is coming into effect from 2026, and there is much these days that's too long-term a period, too long-term for us to comment on. I wouldn't be, anxious at this point about the impact. Yeah.
While we've seen many changes between decisions that have been taken by the Trump administration and eventually what gets rolled out. But, the momentum that seems to be building on going after services, the Hire Act, of course, is more a private, almost akin to a private member's bill at this point in time, which talks about a 25% tax on outsourcing. But the possibility or the probability of that, does that seem to worry you, concern you now?
No, I think we have already enough on our plate to think about. So I don't want to add hypotheticals also to this list. And anyway, as the moment, it is a private member's initiative. It has to get through the Senate, and then it has to get through the House, and then it has to reach the President's desk. So there is plenty of steps for that process, for that particular piece of legislation to make its way through the Congress and to the President's desk. So let's wait for it to play out rather than sort of reacting preemptively.
No, I completely agree with you. But, the impact of all of this, especially as far as foreign direct investment is concerned, and that is something that, we've been trying to attract FDI across sectors into the country. Given the uncertainty, the volatility, the unpredictability, what sort of an impact do you believe this could have in the medium to long term on FDI?
I think the operative words in your question is the medium to long term. In the medium to long term, I think there will be some via media found, and I don't think it will have an impact on the FDI numbers. In the short run, yes, people will wait to see some sort of a resolution to this situation. And if anything, if the Indian system, by that I mean both the public and the private sector, if we are able to use these developments as opportunities for changing the business model on the part of the private sector, or for the government to do what it is doing in terms of focusing on structural reforms like GST, deregulation, etc., they may actually end up as catalysts for higher FDI. And if you look at the first quarter numbers, April to June, the gross FDI flows were $25 billion, so annual run rate of $100 billion at the moment, compared to last year, which is $80 billion. So I think the investment interest from whatever I have seen, people who have visited us from other countries or even from the United States themselves, the picture of attractiveness of India as an investment destination or a manufacturing destination as an alternative to in the overall China Plus One framework, I haven't seen any diminishing of that interest.
Even with the 50%?
Even with the tariffs, yeah. Yeah, even with the additional tariff, etc., the medium to long, that's why I said the operative part of your question was the medium to long term. The medium to long term or the attraction seen in very unhesitant what they said, it remains a top investment destination for them.
Well, that's good to hear. You know, you talked about never missing a crisis as an opportunity to reform, and we're perhaps seeing that play out starting with GST. The Economic Survey had in terms of what the government needs to on deregulation, the easiness, and so on and so forth. We've got the government set up committees under the Cabinet Secretary to look at exactly that. What would you now prioritize in light of the measures already undertaken? But given the need of the hour today, with the global uncertainty being the way that it is, what would you prioritize today in terms of next steps?
No, I think the policy steps, apart from the three important boosts we have given to domestic demand, direct taxes, indirect taxes, and income tax simplification, etc. Now, the other thing that we are focusing on is the deregulation part, because our goals are to boost private capital formation and get manufacturing share of GDP up and increase the share of small and medium enterprises in this. All these three goals are well served by deregulation, not just at the union government level, but also at the state government level. So I think the next important policy agenda would be to committees to and start acting on. Apart from that, yes, there is emphasis on innovation, R&D, but that is more a private sector responsibility than a public sector responsibility. There, the government has done its bit by notifying the Anusandhan National Research Fund and the Research and Development Innovation Fund. No, they have to become active. They have to have the governing structure in place and get to start funding research on. The other important would be to get our energy security in place. We announced that we will energy for the private sector, the provision, etc. That would be, in my opinion, area. And the third, it is a workers, because usually, for example, 2 years ago, notified simplified norms for foreign universities to set up shop here.
Yes.
But in general, education, both school and higher education, we have a lot of input-based requirements. I think those sectors now need opening up for more competition, more innovation, focus on outcomes. I think just as, we talk about external developments, providing the impetus for change, the infusion of AI into the learning and teaching process will also trigger these reforms. So I would say from a structural reform perspective, focusing on education and skilling will be more important now that we have taken care of the demand aspect, and then the deregulation, ease of doing business. The third important bit is the human resources.
Go back to the demand issue that you just spoke of. You said that now that we've taken care of demand, what does that mean in terms of investments? What's the sense that you get in terms of a further pick up on private investments? You've of course been talking about the fact that we've been seeing green shoots emerge on the capacity utilization across sectors. What's the indication on that front? So
frankly, if you look at post-COVID trends, we have had 4 completed years of data. 21-22, very big ramp up in private sector spending. Naturally, it was a sort of a 2021 contraction, a bit lower. It was 23, 24, 25. I think those numbers are going to be. So if you, we will get to see next year. But I think therefore, you would have had 2 great years, 1 disappointing year, COVID. And that isn't the cause, because considering the circumstances, highest rates in the world in general, the Ukraine-Russia conflict and supply chain disruptions in semiconductor chips, all pace of capital formation GDP, it's not something concerning in my opinion. The biggest contribution the government can make, invest to, one is to a platform for demand to rise, which is capacity build up on the part of the sector. The second is the fiscal prudence, fiscal stability, because that brings down the interest rates.
Yes.
And government's borrowing cost has dropped by about 250 to 300 basis points in the last 10 years. And that naturally brings down the private sector's borrowing costs. So basically, making your investments easier to finance and providing the underlying demand conditions. And third, by continuing to invest in ease of doing business, I think these are the 3 building blocks of boosting capital formation, and all of them are in place right now.
Okay, all of them in place right now, and you expect a further pick up as far as capital formation is concerned.
That's right.
Since we're talking about industry, and I think would it be fair for me to say that I've sensed some disappointment in your commentary on how industry has responded by way of wages, etc.? You've made those comments
that is true.
in public forums several times.
No, absolutely. I agree with you. I have made my comments and I continue to make those comments whenever I have conversations with the industry. I think that's important because from a medium-term perspective, there is no trade-off between how well we take care of our workers and how well we perform profitably. There is no trade-off. It's the trade-offs occur only in the short run. And yes, if you look at the track record of India's top 25 manufacturing companies or the entire private sector data, it is true that salaries and wages growth have substantially trailed profitability growth. And this will become even more acute when we are talking about inroads that AI would make in terms of job creation, not to mention job displacement, etc. And I think the medium-term social stability is an important consideration for businesses to be profitable as well. So there is no trade-off there. So that issue remains important, along with what I mentioned earlier in terms of innovation, investment in R&D. These are also areas where the industry has its own role to play in catching up.
Is that another area of disappointment that you believe Indian industry hasn't risen to the occasion, so to speak, as far as innovation and R&D is concerned?
In part, well, I mean, in fact, it's not, I mean, more than me, Mr. Naushad Forbes has been writing about it quite extensively in the last couple of years. But again, I would qualify my observation because my disappointment is in part because if you look at how the Indian pharma industry responded to the TRIPS agreement in 1995, they ramped up their R&D spend quite considerably. So you have a template there. They did not take shortcuts. They actually ramped up their R&D spend, which is how they managed to retain their global market shares in generic drugs and so on. And that's exactly the same thing we need to repeat.
Is it to take that conversation forward? Is this then and
the case with every crisis actually is the only way we will relook and re-examine the business model, and whatever is happening in the last couple of days or three is a very good, I would say we will look back 2-3 years from now and say that was actually a good thing that happened because we are now much stronger, more diversified and have a different operating model. I think that is what we will see 3 years later, although it may look very uncertain right now.
Speaking of diversification, I mean, of course, we've got our challenges as far as the India-US partnership is concerned currently. But, we are trying to ink and forge for free trade agreements, whether it's with the EU or other nations. This diversification, how do you see it playing out again in the medium to long term? Because in the short term, it will still take time for these agreements to operationalize.
I totally agree, because even the agreement signed with the UK has to be ratified by their parliament.
Correct.
Right? So I understand that. But naturally, this is what we can do and we should be doing, which we are doing, which is to sort of open up geographies for our exporters. And it will definitely have an impact. In fact, if anything, we should remember that if most of these markets already have a very low import duties in their markets. So all that India is getting is access to these markets, because as a country which imposes a higher duty, we are the ones who make more concessions in these negotiations than they make. In general, their average MFN rate is much lower than ours. So, in that sense, Indian exporters will get an opportunity to compete in those markets. It doesn't mean that it's sort of a free way for Indian exporters into these markets, that they're going to come in and immediately get their market share up. We have got these agreements get our exporters as a leg inside the door, inside the hall. And how we compete there depends on not only industry's investment in competitiveness, R&D, but also in how effective make the cost of manufacturing more affordable. It requires not only deregulation, structure on input materials, interest, etc. So that contribute over. That is how we will translate these free trade agreements into actual export growth numbers.
Since we're talking about decisions that policymakers will have to make, the Prime Minister's comments yesterday in his address to the nation on Atmanirbhar as well as Swadeshi, Atmanirbhar self-reliance is concerned, we've seen him act on several, including, for instance, in the defense sector, where there has been a concerted attempt at indigenization.
That's right.
But what do we understand Swadeshi to mean, and what will that result in terms of policy changes, if any, if at all?
No, I think what he meant, and in fact, he has said it even in recent past also. As long as the money could be coming from anywhere, but as long as the good is made with the sweat of the Indian, then he calls it a swadeshi or a India-made good. So in that sense, this signifies a certain openness to foreign direct investment. As long as it is manufactured here, then he calls it a swadeshi, which is, I think, is an important statement to understand that it is not an anti-foreign investment position at all. Now, with respect to buying Indian goods, yes, I think the important thing is to also make it easier, as I said, to manufacture those goods in India. And right now, for example, if you look at the kind of the components that the categories of goods we import from China, predominantly it is intermediate goods and capital goods, which are necessary for our own industry to become self-reliant in manufacturing. So there are areas where we need to sequence our made in India. We need to make sure that for our finished goods to be made in India, we need to have these supplies of intermediate goods and capital goods. Therefore, getting into the global value chain still is an important priority for Make in India to become a very viable long-term reality.
Well, speaking of global supply chains, it was again the economic survey last year that talked about the need to re-engage with China. We've now seen the government, as well as the Chinese government, make steps to further the cause of economic re-engagement. There's a lot of talk around the possibility of press notes to try and draw in investments. What do you think the way forward should be on this economic re-engagement with China?
I think it will be somewhat difficult for me to comment on what should be the way forward, because I think there are many more steps required for both the countries to take it to the next level, etc. But the important point is we need to figure out a way to improve our own resilience in terms of supply chain, because right now it is skewed in favor of more imports, which is what I wrote about in the economic survey. That still remains the case. But in what manner and shape this will evolve in the coming months and years, because a lot of water has flowed under the bridge since I wrote this last July in 2024. But how exactly it will move forward is still very difficult to sort of visualize. But I think there will be some movement along these lines, I suppose.
Well, speaking of movement, let me get your take on the movement of the rupee and what you make of that, as well as the moves in the bond markets, global as well as here in India, and the interest rate trajectory as well. I know the MPC's meeting, you won't comment on that, but at least as far as the rupee and the bond market is concerned.
No, I think I'm not too concerned about the rupee's current sort of recent weakness or the current levels per se. It's all right. Obviously, we have ample foreign exchange reserves and we have very low external debt. So it's not that the rupee is vulnerable in any particular manner. It is just maybe the current demand for dollars or the reduction in the inflows on the portfolio side may have contributed to this weakness. So I'm not worried about the one.
And does it actually also help offset some of the, at least as far as the exporters are concerned?
To a limited extent, it's actually a good thing because if the Indian rupee is depreciating on the back of a depreciating dollar, it does impart a certain competitiveness in the near term. But of course, anything that is overdone will be a challenge. But that is not something we are facing right now. The interest rates, yes, I think. The 10-year bond yield went to 6.6, but we are now hovering around 6.5 or 6.45. I think it's still room for it to go down, and it will go down because right now maybe the market is concerned about second half supply and RBI's monetary policy stance and what will be the fiscal deficit, etc. And as I said, we are confident of maintaining the fiscal deficit. The second half market borrowing will be unchanged, etc. And I think we will know what the Reserve Bank decides. So I do believe that the Indian bond market is a pretty good opportunity for investors at the current 10-year yield levels. The third point was about?
Inflation.
Oh, I think, frankly, if you ask me, until the end of next calendar year, by and large, I see pretty benign inflation trends. I know that I am speaking a little too far ahead because next year's monsoon will play an important part. But assuming that it's a normal monsoon, I think then we are looking at fairly benign inflation until the end of the next calendar year.
Until the end of the next calendar year. So what will that then mean as far as the business of inflation targeting is concerned? The RBI discussion paper is out. I don't know whether the government has sent in its feedback or not yet. No?
No. I think we haven't responded officially, and I don't think it will serve any purpose by commenting on it in public at this point.
But do you believe a status quo perhaps is warranted, or?
I suppose, because on the face of it, as long as the central bankers have the flexibility and are willing to exercise it and not be doctrinaire about it, then I think the framework, as long as the framework doesn't become a sort of a constraint, then it's fine. Because sometimes once a framework is in place, disrupting it also will send confusing signals to investors.
So a status quo, even though you haven't officially sent in the feedback yet.
I don't know about that. That is a question you need to ask Secretary Economic Affairs. It's not my prerogative. I mean, we did write about it in the economic survey last year in a conceptual manner, discussing the pros and cons of inflation targeting for a developing country like India. But having written that, I would also acknowledge the fact that once a framework is in place, you have to be very careful about disrupting it also.
Well, fair enough. Let me end by asking you, you are, of course, going to be presenting the economic survey come February next year.
January.
And I would imagine that we'll get some sort of an update from you on the measures already undertaken, especially on heads like deregulation.
Yeah,
what could that potentially look like? How much ground has been covered?
No, I think it will be unnecessarily spoiling the whatever little fun people have in reading economic surveys. I don't think I call it a fun document, but anyway, but whatever little surprises.
It's a voluminous document for sure.
Sorry?
It's a voluminous document for sure.
Exactly. So whatever little surprises, I don't want to spoil it by talking about it right away, but having written about deregulation, it's only natural for us to write about the progress that the government has made, not just the government, but the governments around the country have made in the last 1 year. That will be something that we will cover in the economic survey.
Well, we look forward to the next edition of the economic survey. CEA, many thanks for joining us here on Reforms Reloaded. Ladies and gentlemen, a big round of applause for the Chief Economic Advisor, Anantha Nageswaran. Thank you very much for your time. Thank you, sir.